Did you know that realtors have to take continued education, like teachers, accountants, and engineers? Because these professions are always changing and evolving for the better, they make us take continued education so we can evolve and get better. Okay, firstly, I don't want to talk to people about their finances. That is not the fun part about making folks homeowners and building generational wealth. But here we are. I first want to get the horror stories out of the way because you get a bunch of realtors in a room and that's all we want to talk about. But first I want you to learn from others' mistakes and let's not make the same mistakes, okay? So here are some horror stories from class. One buyer ordered $20,000 in furniture from Raymore and Flanagan over the weekend. Their closing was on a Monday. Well, the lender checked their credit again that Monday on the day of closing and the closing was then canceled. Why? Because the buyers spent that $20,000 on furniture and that caused an issue with their debt to income ratio. Okay? Another agent shared about a client who they got the house, so then he went and bought his fiance an engagement ring that damaged his debt to income ratio. And in their story, the fiance said she wanted the house, so he returned the ring and all was well. Another instance was a buyer had an accident, a car accident, and needed to replace their car so they could get to and from work. So they had to choose between a house and keeping their job. They kept the car, but due to the new income debt to income ratio, they were no longer eligible for the purchase price on the home. That's how serious debt to income ratio is. Your lender will verify the information you provided and fact check everything up to 3 days before closing. They may even call your employer again. They may check your credit score again. So it's very important that once you're pre-approved, you maintain the status quo. Okay? Debt to income ratio is very important. So let's start there. The easiest way to find out how much you can afford is to get pre-approved for a mortgage loan. Okay? Pre-qualified versus pre-approval. There's a difference. If you get pre-qualified, you likely just answered a few questions on the lender's website, and the lender gives you a value based on the answers that you submitted online. This is a very introductory level, and it will not be accepted by a home seller or a home seller's agent. Whereas a pre-approval, you do the same thing, but you provide the lender with receipts for that information that you provide. You will need to provide the lender with documentation like bank statements, not screenshots, recent pay stubs from work, past income tax forms, likely the past 2 years, okay? I recommend you start a physical folder. The Dollar Tree sells these snazzy folders for $1.25. They are made of like a flexible plastic and they keep everything together. But this isn't about spending money. You can also use one of these traditional folders, But I recommend that you tape or staple this up to keep everything in the same place, kind of like this one would be. It's more like an envelope, So tape it up or staple it. You want to keep all of your stuff together, easy peasy. All right. You also need a digital folder that you can access pretty easily. Make it simple. Name the files something simple and easy for you to remember because you will likely be sending this information or uploading it onto your lender's website. And they will give you like a, what do they call it? Encrypted website to put your information on. So it's not just, going to be ransacked by, the people who ransack things on the internet. Okay. So that's where we're going to start with a physical folder as well as a digital folder. Okay. With the pre-approval, there is no commitment from the lender. You still have to go through the underwriting process, which is when somebody from the lender will fact check all that information you provided. You have to expect that they're going to ask for inquiries while you're going through the underwriting process. They'll ask you about that phone bill you missed from 2020. They'll ask you about how come you were 5-10 days late with your Macy's bill in 1988. You should be aware that these inquiries are coming and you should be prepared with your handy dandy folder. The lender tells you how much mortgage your current income will support. Somewhere, down the line through this historic process, lenders have determined that buyers can afford to pay anywhere between 28 to 36% of their gross income in debts. That means your mortgage payment, real estate taxes, insurance, housing insurance, car payment, credit card payments, child support payments, alimony payments, any debts you owe may not exceed 36% of your gross monthly income. Okay, that was 36%. Now, this percentage varies from lender to lender. Some will even go higher. But keep in mind that these companies are in competition with one another, and they are constantly coming up with new loan programs to help more buyers buy homes. But if they go too high, what happens with that is if they start to have buyers going into default, that can damage that lender's ability to offer loans. So that's why they have to be careful, okay? I just want to say that even if the lender says up to 50% of your income can go to debt, ultimately, you need to decide how much you're comfortable with spending on housing. Because remember, you do have other living expenses. So do your math. I quick Google DTI calculator, which is debt to income calculator, and there are several available online to help you out, to help you figure it out so you know your debt to income ratio. I hear people say, I'm not good at math, I'm not good at figuring this stuff out, but you need to get stronger with this information as you're going through this process, or people will take advantage of you. Lenders look at debt-to-income ratios because research shows borrowers with high debt-to-income ratios have more trouble making their payments. Again, each lender sets its own debt-to-income ratio requirements within the law. Home buyers who have the best credit get the best rates and the best terms for their mortgage. When you get pre-approved for a loan, the lender looks at how much you earn, who you owe, how much you owe, and what do you have in the bank. That's what they're looking for. When you're going through this process and you're working with a lender, you need to be comfortable with asking them questions, okay? Because you're in the driver's seat. And more importantly, you don't have to be rude to ask questions. This is a very important purchase, okay? So get all your questions, be prepared. Now, another question, big question, is how much do you need for closing? Great question. Ask your lender for something called a good faith estimate on closing costs. Remember, you're in the driver's seat. Sure, they don't know exactly until you know the house, right? So then they can put in all the numbers. But give them like a dummy house, a pretend house, so that they can plug that in and give you a general idea up front of what the values will be that you need to bring to the table. Because you need to know. You're giving them your business. This is a 30-year commitment for you. If you don't feel fairly treated, you may need to take your business elsewhere. Because you need to feel comfortable talking to them. I find that folks feel more comfortable asking me, their agent, and that's fine. But remember, again, you are the customer and you're likely not their first loan, and you probably won't be the last. And we as realtors, we don't have the same tools as the lenders. We can prepare a guesstimate, what we call a buyer's estimated closing costs, but we are not the lender and we don't know what their fees are. They do. So get the lender to give it to you up front. It's also very important to fact check your lenders. Are you thinking, but how can I fact check a lender? I'll tell you, with another lender. You should get pre-approved by at least 2 lenders. You want to make sure you're getting the best rate. You want to make sure you're getting the best value for your pre-approval, and a second application will do that for you. Will it ping your credit? Yup, maybe a point or two. I don't know for sure, but it is considered a hard inquiry, okay? But you need at least one other one to bounce it off of to make sure that you're in the same ballpark. What if one gives you $200,000 and another one gives you $250,000, and then one gives you 8%, but one gives you 4%? That's why you want to do it with at least one other lender so that you have an idea of which is better for you. It is recommended that you apply with the different lenders all within the same day or week if possible. Now you might be saying, why? The biggest reason is because interest rates change. For example, Lender A will offer you what is available on April 1st, but lender B may offer you a different rate on April 15th when you apply because rates have changed and you're not comparing like information because there's two different dates and because of the volatility of interest rates. No one can control them, other than the Feds. So it's best if you give lenders the same playing field so you are comparing the same information within the same time frame. So 1 week is probably good, okay? Something else that is important is FHA loans have a delinquency rate of about 10%, whereas conventional loans is less than 2%, okay? And this hopefully helps you to understand the difference in the requirements to secure a conventional loan versus an FHA loan. Conventional loans also are not government insured, whereas an FHA loan is. So what does that even mean? What that means is if someone fails to pay their FHA mortgage and the lender forecloses on the property, they do have to do the foreclosure process. The government will pay a percentage to make the lender whole who took a risk with that buyer. So that's why there's a stronger guideline of approval for conventional. Now, I'm sure no one intends to default on their mortgage, but it's very important to know your numbers and do your math and get comfortable with your math so you can stay within your comfort zone. Which brings me to another topic. Be honest. Don't try to hide stuff to help with your pre-approval, trying to get more, hoping the lender doesn't find out. Because two things. One, the lender will probably find out. And what if it's after you've already submitted your offer? Now, not only you, but you and your realtor look bad. And what if that debt that you're hiding really damages your ability to pay after you get the house? Now you're in default. So did you really win? Do the work. Building good credit takes time, sometimes a whole year. But it's likely worth it to prevent foreclosure in the future. Also, did you know your credit score factors in your home insurance premiums? Well, for now at least, working on your credit is worth the effort. Also keep in mind, just like rent amounts, your mortgage will go up. It should be minimal, but if your taxes change, if your mortgage insurance changes, that will affect your mortgage going up. Especially if you got an adjustable rate mortgage, right? If your home insurance rate change, your mortgage is going to go up. And this can be anywhere from $20 to $100 a month. But I definitely want to advise you to anticipate a slight shift every year. It is definitely going to, slowly climb up. Now, on the flip side of that, once you reach 20% equity in your home, the PMI, which is your private mortgage insurance, will no longer be collected. And as the buyer, you pay PMI if you didn't have a 20% down payment, which I think is a small price to pay for a jump start on home ownership. Especially since you don't have to pay it for the life of the loan. It's not like you have to pay that PMI for the full 30 years, okay? The law does require lenders to automatically cancel PMI once your loan to value ratio reaches 22%. Zillow doesn't know me, so this is an ad, but I always recommend the Zillow Mortgage app. But any payment calculator will do, okay? I like this one because it's easy to use. It lets you adjust the price of the home, the down payment amount you're going to put, the taxes, the HOA if there's one involved, the interest rate, the homeowner's insurance premium, the loan terms, 15, 20, 30, basically everything that would be included in your mortgage payment. These calculators allow you to play around with that number and get comfortable with it, okay? I love this feature. These calculators are so helpful because it gives us some power. It allows us to play with the numbers and also to fact check the lender's calculations. This way we can make sure we know what we're getting into and find our comfort zones because we have to live with the payments, okay? So I want you to have all this power while you're making this big decision because money is relative. We all spend it differently. technically, you may be able to afford a $1 million home based on your income. But if that mortgage payment means your family will have to give up other luxuries like vacations, private schools, fancy clothes, maybe one of you wants to be a stay-at-home parent or stuff like that, that is a decision for you and your family, not me, not your lender. There will also be new bills once you move into this home that you didn't have when you lived at home or when you were renting. We used to call this being house poor. You know, when you move into a house, you don't have money now for all of those things that you used to have money for. But I might be just showing my age using that terminology. But I wanted to share that with you. So just keep this all in mind. The mortgage process is not a one-size-fits-all, okay? It may be a little bit different for you. Your finances are unique to you. So definitely work within your means, okay? As always, my name is Tiffany Nelson, and if you are buying or selling in the Allentown area, I would love to hear from you. I did a video on debt to income ratio, so if you need some help with that, go watch that video right now. Thanks so much for watching. Bye for now.